Welcome. My name's Dan Druzianic. For those of you who don't know me, I'm a director at Moore Markham's Chartered Accountants. It's my pleasure to introduce this economic webinar presentation to you. At Moore Markham's, our strapline for our brand is helping you thrive in a changing world. And yeah, our world certainly has changed since COVID-19 arrived. Today we're really fortunate to have Jared Kerr, Chief Economist at Kiwi Bank, speaking on how the next period is going to play out. Jared is a Kiwi, but has spent most of his career overseas working for big financial institutions like JP Morgan, CBA and Credit Suisse. He returned home in 2018 to take up his latest role and has rapidly become a high-profile economic commentator in New Zealand. Jared's presentation will go for about 45 minutes or so, and we'll have time for several questions at the end if you want to type your questions in. So over to you, Jared.
Thank you, Dan, and thank you for inviting me on today. There is a lot to talk about, and I'll do my best to give you an overview of what we think is happening and what we think is important. But then when we open up in the Q&A session at the end, please come forward with your questions, and nothing's off limits. And I'll do my best to sort of navigate my way through those. I'm just going to share my screen with you. Hopefully you can all now see a bit of a forest. The title, I think, explains itself quite nicely. Unprecedented times and unprecedented measures. So we're in a situation now which is quite difficult to quantify, and it's quite difficult to figure out exactly how we're going to grow our way out of it. A lot of parts of our economy will fare quite nicely and keep growing and keep doing what they do, but there are some parts of our economy which I think will be damaged, and I hope they're not damaged long term. The key, I believe, to our unprecedented measures is in infrastructure investment, and the government, to their credit, was already ramping up infrastructure investment because we have what we call an infrastructure deficit in this country, which is an economist's way of saying we haven't spent enough for 30 years, and we could get quite a huge return and boost in productivity if we rebuild our economy for the future. And I think this particular crisis will give us the opportunity to really focus some resources that haven't been spent in prior decades. Now, I'm just going to cast your mind back a few months and remind you of the trade war that was going on between the United States and China. And thanks to Trump's latest tweets out this week, it reminded us about that relationship between the two superpowers, economic superpowers of this world. Now, what I like about this chart is it just shows quite simply how good China is at trading and how powerful they are, and how their reach really has extended in the last 30 years. So they are the #1 trader out there. They're the world's manufacturer, and 124 countries consider them to be their largest trading partner, Australia and New Zealand part of that. Whereas you look at the United States, the largest economy, only has 56 countries that consider them to be their largest trading partner. The external part of the US economy is actually really small. They are quite insular as an economy, whereas China is obviously a lot more open. But those lines, they could also be flights, they could also be tourist travel. China is not just a manufacturer, but it's also a growing consumer of goods and services globally itself, and its reach really has expanded. Now, a virus hit, and you all know where it came from. Well, Trump thinks it came from a laboratory. Some of us think it came from wet markets. It doesn't matter. It came from China. And I was actually really surprised at how we looked at this as being a Chinese problem to start with. And financial markets didn't actually move a great deal when China saw this virus and actually started to lock down. And then we started to think, oh, this is going to be a bit of a trade disruption. Well, as you all know, it spread out of China very quickly, and it worked its way around the world in what was quite a rapid spread of a virus. And I don't think we've ever seen a spread in a virus like this before. And it's just part of the fact that we are much more globalized these days, and we do a lot more travel than ever before. But once the virus made its way into Korea and then Italy and then worked its way through Europe, that's when financial markets started taking it seriously, and we saw equity markets get hit quite swiftly, and the damage was starting to be priced in immediately. Equity markets have actually performed very well in the last month, a little too well for my liking, but you know, you can see fund managers, asset you know, the people who buy these assets are starting to become a bit more convinced that, you know, there's light at the end of the tunnel, which is a real positive. Now, just on the numbers that we're forced to consume every day, the virus obviously got out of Asia and into Europe, and where the numbers are the darkest is in Europe and the US. That's where we believe the epicenter is. And then you look at the countries like China, India, Africa, South America, you think, well, actually, it's pretty light. That's just because they're not recording cases. You know, I don't think Africa or even large parts of India have the capacity to really start recording, you know, instances of COVID-19. So all the numbers that we are receiving grossly underestimate the spread and just how far it's gone, because we're relying on countries, third world countries, to deliver data that they can't take. But when you look at where most of the world's population is, well, it's heavily in Asia, and that doesn't sort of marry up with you know, the number of cases that are reported. So I think what's in China, what's in India, what's in large parts of the world is clearly a lot higher. How this fed through straight away was China shut down, and then other countries started shutting down. When you shut down, that's it. You're not producing stuff. And when you look at global industrial production, the orange line there, you see that there are periods where it contracts, and the blue bars, which follow quite nicely, are the returns in global equity markets. So global production today has fallen off a cliff. Equity markets fell off a cliff for a short period of time and then really started to ramp back up in the last month. I think it's premature, but as we open up, and we are opening up at the moment, that orange line is going to go from being a big negative to a big positive as we go into 2021. And that's what I think we'll all face. We will see really bad news now, and that bad news gets reported in a month or two's time, and we have to work our way through that. But hopefully we're in a position where we have opened up, and as we go back to work, most numbers that we look at are simply growth. So if you've fallen and you start adding little bits to it, then the growth rates look really high. And I think we're going to see some pretty decent numbers going into 2021, and quite a strong rebound over 2021 for this huge shock that we're going through today. when you look at IMF and other forecasters, you know, they put some good forecasts together around the world, and they're a little slow in changing their forecast, but when they do change, they're pretty helpful. And we had a world that was growing at around 3% coming into this, and now we're going to have a world which is contracting by about 3%. So that's a huge swing, and to see global growth fall by that much, you actually need to go back to the 1930s to find something comparable. And in coming up with these numbers, you really do want to go back in time and try and find similar instances, but there aren't any. The closest we can find is the Great Depression, which was a different beast entirely, to get the magnitudes of the decline that we are basically imposing on ourselves at the moment. But what doesn't compare to these other situations is that the Great Depression, people didn't see an endpoint. They did not know how long it was going to last, and they also did some very things with regards to fiscal austerity that actually made things worse. So I think we've got an endpoint, which is important. It might be 3 months, it might be 6 months, it might be a year, but we know that there's going to be some sort of endpoint. There's going to be some sort of vaccine coming through. And as we get closer to it and more confident that we're near an endpoint, you'll really see growth ramp up next year. Now, as an economist, we sort of find ourselves running off a cliff every now and then, and we've run off one at the moment. We knew we were running into a recession, and we were kind of looking down as we ran off the cliff, but now that we're in mid-air and we're sort of looking down, how bad is the second quarter going to look? Well, it's going to look pretty bad, and I think it's going to be the worst economic contraction we've ever recorded in one quarter, because we've done so much so quickly in closing everything down. And we'll lose about a third of our economy over the 4 weeks in level 4, and we'll lose about a quarter of our economy over the level 3, and then smaller amounts as we come into level 2. But you pull those together, that points to a quite a sharp contraction in the second quarter. But it's how we dig our way out. It's how we climb out the other side that's important. You all know why we did it. And I just want to say, going into the lockdown, I think it's very difficult to criticize the way we went in to lockdown, even the length of time that we've been in lockdown, because we saw what happened in Italy. We saw what happened in other countries where the virus just spread quickly through the country, and you end up in a situation with a lot of sick people, but not a lot of healthcare. Obviously, we have squashed the curve. We really hammered it lower, and we've had quite a fantastic outcome here, which enables us today to debate how we come out. And I think the debate is important. We really need to talk about getting some clarity around how we're coming out of lockdown, and how the government will respond to future flare-ups from here, because businesses need certainty, and they don't have much certainty at all around what happens if they go back to work next week or the week after, and then in 2-3 weeks' time they're asked to go back into lockdown. And for many firms, they tell us that would be the worst case scenario. They prefer not to go back to work. And this chart here, which we put together based on international research at the time, I think shows you exactly how well we've done. Now, we put that dotted green line together based on the way the virus spreads overseas. And when we got to 100 cases in New Zealand, we said within a week we'll be at 1,000. And within another week, we'll be at 10,000, and in another week, 100, and then we'll be pushing towards 1 million today. From 100 to 1,000, we were bang on, but as we went into lockdown, that really did flatten the curve. So that is the definition of flattening a curve, and we did extraordinarily well. We would, without a shadow of doubt in my mind, have at least 100,000 cases today had we not gone into level 4. So everything up to this point, I think, has been fantastic. But we also need to think, well, now that we've done so well, can we open up even faster? So what have the policymakers done? Now, it had to start with the RBNZ. The RBNZ had to make the first move, and then that sort of opened the gates for the government to come out and do what they did. Now, the first thing the central bank did was cut the cash rate from 1 to 0.25%. That is what they consider to be an operational low, and I can talk about that if you like, but it's an operational low for now. The other thing they did was they gave term asset funding facilities and a US swap line, which probably not so important for this audience, but I just want to say that giving banks access to funding is very clever. If banks start screaming out for liquidity and money, the TAF and the swap line enable us to get US dollars should we need them, and a lot of banks have US dollar exposure. So that's sorted out with the Fed. We have a swap line there for 30 billion should we need it, and we don't. And then the TAF facility enables us to throw bonds at the government, at the central bank, and the central bank to throw us cash. What's important there is you are making sure that there is liquidity in the financial market. Without liquidity in financial markets, things get really nasty really quickly, and that's what we learned in 2008. So those two little bits, for me, are very important, but for the general public, probably not so much. The key, the main response, I believe, from the central bank has been the 30 billion quantitative easing or large-scale asset purchases. The idea there is the central bank creates cash on one side of its balance sheet, and it takes government bonds on the other side. So they're basically crediting the banks with some cash and taking bonds off the banks, and then that enables banks to move up the risk spectrum and buy councils or corporate debt, or even just take some cash out if they need it. From the government's point of view, this is critical in that you have a government with very low debt to start with, 75 billion, but they want to ramp it up to about 125 billion. And in that process, there's always a worry that there might not be a buyer for a government bond in that sort of market. Well, the RBNZ has come out and said, we will take down 40% of all government issuance. Okay, wow. Now we know there is a backstop buyer for government bonds in the New Zealand market, and they can buy unlimited amounts if they want to. So that is a huge signal to banks, fund managers, foreign investors in our debt market that there is a cornerstone buyer who will buy those bonds all day, every day. And now the government is increasing their bond issuance, and the interest rates on those bonds are at record low, and they have no problems getting those bonds away because RBNZ's buying, banks are buying because we know the RBNZ's buying, and foreign investors are buying because they know that the banks and the local fund managers are buying, or because the RBNZ's buying. So it's just pure poetry in motion. Then you kind of work your way along what the other bits and pieces that have been done, and I think they've moved out to buy LGFA. I think they'll have to buy other government, semi-government bonds. But then more recently, just last week, the central bank removed the LVR restrictions, which are important. Removing LVR restrictions, you might think, oh, they've done that so that the banks can lend a little easier, a little freer going forward, and that's true. That's part of the equation. But the main reason why they removed the LVR restrictions is because there are some households who are already up against their LVR restrictions, and more importantly, some small businesses who have debt associated with their mortgage, and they're already up against LVR restrictions, and they want to go on a mortgage deferral, Well, if you go on a mortgage deferral, you know that by the end of it, the interest that you haven't paid sort of goes on top of the loan, and you would have broken through your LVR restrictions. So removing those LVR restrictions enables more firms to go on to the mortgage deferral and end up with a slightly larger mortgage at the end of it. And that was important, and it was a great step. The government has done a lot, considering what they have in front of them. Already ramped up infrastructure spending, ramping up more, fantastic. Coming out, helping Air New Zealand all day, every day. They should do that. We need a national airline. It is also a strategic asset, and you could say it's a military type asset. You know, having the ability to fly people around, go and collect people from overseas, very, very important. So that was good. The business finance guarantee scheme I thought was fantastic. I thought that's exactly you know, a way to provide businesses with some funding should they need it. Very, very little take up. Some of the terms and conditions were a little complicated, and firms by and large don't want to take on debt in this environment unless they really have to, and I'm not sure we've got to that unless they really have to part. But for now, the take up is actually really quite light, surprisingly. The wage subsidy, excellent, probably the best piece that they've done, and they were able to do it as quickly as they had because they had done it before the Kaikoura earthquake. So this was something that they could roll out literally straight away rather than having to spend a month, you know, getting legislation through and mucking around. So that was probably the better piece in hindsight, and it keeps employers linked to their employees for that much longer. So as we come out, hopefully that job is still there. Now, other bits and pieces, you know, tax reliefs and talk of doing more. But recently, the small business cash flow loan scheme, I think, again, another good option for small businesses. You know, you get a certain amount of money and then an extra $1,800 per worker, up to 50 workers. 0% if you pay it back in a year, 3% if you decide to use that for 5 years. But again, same with the business finance guarantee scheme. I'm not sure, even at 0% interest, there are a lot of companies out there willing to take on more debt in such a highly uncertain time. So we'll have to see if that's effective. So from here, the focus really is on just next week. We've got the Reserve Bank, their monetary policy statement, that will give us their updated forecast, which are very similar to Treasury's. That will tell us that the cash rate, I expect to remain on hold at just 25 basis points, but that they will consider negative interest rates in the future. And I think that's a really interesting discussion point to have. I don't agree with negative interest rates, just quietly, but it doesn't mean we don't discuss them, and it doesn't mean they won't happen. And I also think that the central bank will come out and increase their large-scale asset purchases from 30 billion to say 40 billion, because we know Treasury's ramping up their issuance, and they're going to want to keep ahead of the curve and make sure that the bond market's performing as it should and interest rates aren't rising. This is what the market is currently pricing for the RBNZ. So in their February monetary policy statement, the RBNZ made the mistake of increasing their OCR track from 90 basis points back up to 1%. They said they were quite comfortable. That caused a lot of economists to take out their thoughts of rate cuts. We left our rate cut in because we saw the virus as a threat. So that was unfortunately a mistake, but then they delivered a 75 basis point emergency cut in between meetings down to 25. The market's gone further. Markets always go further. They say, yeah, is that it? Is that all you've done? No, really? I reckon we'd do some more. And you see the green line at the bottom there has the terminal rate for the cash rate going to 0. and staying there for a while. Now, what that is a combination of traders taking bets that yes, the central bank does cut to zero, or cuts to some sort of 0 to 0.25 band, like the US Federal Reserve has done. And they are also betting on the off chance that you see a cut into the negatives. And that's not out of the realms of possibility at all. In fact, I believe Dominic Stevens from Westpac is actually calling just that, and he could be right. I mean, we really are looking at quite a radical central bank governor who is quite keen to test the boundaries and do what he believes is best. So there is a you know, I would say a decent probability of a negative cash rate in the next year or so, and that will blow the minds out the back of a few people, that's for sure. Now, how do we get to all this? Well, we look at basically how long we are in each alert level 4, which obviously we don't know. We don't even know how long level 3 is today, but we just make guesstimates, and we say, well, if we were in level 4 for 5 weeks, and then we're in level 3 for 2 weeks, maybe 3, don't know, and then 2 and then 1, how is that taking? How is that affecting the economy? Well, basically, in those different levels, level 4, you were losing, over a third of your economy, of your output, and then level 3 about 20%, and level 2 about 10%, and then level 1 about 4%. And it's all dependent on how long you're in each one of those 4. And of course, it might not just be a nice simple 4 3 2 1. It could be a 4 3 2 3 2 4 1. We don't know how it's going to play out, and all these different scenarios we put them in, and we see what things look like. But our central scenario is for a massive contraction, some sort of big pullback, and then almost like a W-shaped recovery. As you see a big decline in this quarter, and it bounces back, and then we see an economy which has less income growth, less confidence going into next year, so it sort of tapers off a bit, and then it starts to grow again. But when we look at the industries that are affected, it won't surprise many of you that the government is at 90%. I can't really think of any situation where a government is shutting down. So that's a big part of the economy which is running at close to full tilt. And then you have our primary sector, which running at 75% in level 4, back up to 90-odd% now. I mean, farming, essential, keep it going. Manufacturing bouncing right back into level 3. This is why we spent a lot of time wanting to get into level 3 as soon as possible, because a lot of our industries start to bounce back in the grey bars compared to where they were. The ones that we are most worried about: construction was hurt for level 4. Now it's bouncing right back. That's the one we need firing hard. But then you look at accommodation, food services, tourism, moving from 11 to 19%. That is the part of the economy that will have to live on scraps for a long time, and one that we will need to get creative to keep these businesses going for when the foreign tourists come back. So this all translates into an unemployment rate prediction, and if we're losing growth, if we're losing companies, which we will, then we're losing jobs. And this is, again, depending on how long we're in lockdowns, etc. Our best guess is that we're going to be facing an unemployment rate of at least 8-9%, possibly 10-11%. And then there are some downside scenarios where the unemployment rate goes up to 14, 15, 16%, and a really bad scenario where it could go as high as 26, 27%. And that's the one that Treasury put forward to the government. If this happens, if we're in lockdown for almost a year, then you lose a third of your workforce. The clever thing there is Treasury really did lay it out as to how bad things can get to really motivate, I believe, politicians into doing a lot of the responses, and we'll see a lot more next week on the back of it. So this is an idea as to how things are likely to pay out. We might see an unemployment rate that spikes to 10%. All this extra fiscal spending comes through. The central bank might even do a little bit more here and there, and then we get into 2021 and the unemployment rate slowly starts declining from 10%. That is the scenario that Treasury has given the government, provided they increase their expenditure from 20 billion to 40 billion or 60 billion. And obviously the higher you go, the lower pressure on the unemployment rate. So I would expect to see a budget that shows expenditure from the government related to COVID-19 pushing through $50 billion. And the Treasury has basically outlined, you either do it or you don't. And if you do it, you get all these good benefits. If you don't, well, we'll be mopping up the economy for years to come. What that means for house prices, look, we didn't muck around here. You'll see at the start of the forecast period, we had seen quite a sharp bounce in house prices last year, and we were coming into 2020 and we were forecasting another 7-8% increase in house prices this year. We were pretty convinced that we had enough momentum, and the shortage in housing was there to keep prices moving. Obviously, a shock like this and a rise in unemployment like the one that we're forecasting will put downward pressure on house prices. How far, we obviously don't know. We just run a model that gives us some sort of guess, and our central scenario shows a fall of around 9-10% by the end of the year, which is quite a sharp fall. But then downside scenarios on underneath that, you can see a decline of 20% easily enough if we're in lockdown for another few months, as an example. So watch that space. The correlation with unemployment and house prices is pretty clear, particularly when unemployment's spiking. You get a spike in unemployment rates, people are forced at some point to throw the keys back. You see a spike in defaults at banks, and that passes on to the market with the supply demand dynamics changing. Investors get nervous. The people who are forced to sell are forced to sell. So prices are discounted in that world. And what does all of that mean for overall inflation? Well, if you've got house price inflation coming off, you should really see rents at least cooling, and those are big parts. And then you look at the rest of the economy, and it's hard to see a lot of inflation being generated around New Zealand in the next year. There'll be a lot of discounting as we come out of COVID-19. A lot of retailers trying to clear old stock. A lot of retailers trying to get, shattered consumers who are a little nervous, fired up with new products. And in order to do that, you show them a price that you think they can't refuse. So there is an element of discounting to come through. And on top of all of this, I'm sure you're all aware that the oil price, which goes into just about everything, has come off as well, although it's bounced back in the last couple of days to $30 a barrel. It did trade, believe it or not, at minus $40 a barrel. And for any of you who don't believe me, there's a chart of the oil price dropping below zero for the first time in history to minus 40. And that is just a classic market malfunction, where you have these reports of areas running out of storage, and you have people who have bought a contract to take delivery of oil in May suddenly realize, I've got nowhere to store it. I better flog the May contract and buy the June or July or some other contract down the road. So they literally dumped May, bought June, bought July. So the price of oil for June, July went up to sort of $21, $23. But because they were dumping May, no buyers, went all the way down to minus $40. Now, someone always wins in these situations. Someone would have bought a whole bunch of oil at minus $40, and 3 hours later, it was trading at 50 cents. So obviously, they made $40 per barrel of oil that they made. But that's just me getting excited about a market malfunction. But the main point here is recessions kill inflation, and we've had a pretty bad recession, and it's going to take a while for us to get out of it. And with inflation likely to go to zero or even have a bit of a deflationary event for a while, governments and central banks do not have to worry or fear the inflation beast. They have to fear the deflation beast, which is much more scary, and we don't know how to handle it. So their response function from here is clearly going to be stimulate, 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 stimulate. And I hope we get some of that sort of stimulus next week from both of them, because they will be looking at these inflation numbers. They know these growth numbers, and they know that, you know, this time next year, if they don't do anything, we could be in a deflationary world with unemployment rates in the 20s, and that's not pretty. So we will see a lot being thrown at it, and I'm quietly confident in Kiwi ingenuity, in global ingenuity, that we will be bouncing back. And I do like the fact that we're already talking with Australia about broadening our bubble, so to speak. Now, I've covered a lot. I'm sort of wanting to hear your questions and what you want me to talk about. So I'll open up now.
So, Jared, one of the questions I've got is negative OCR. I think the Westpac economist was predicting it might go to negative 0.5. What does that mean for someone with a house mortgage or a business loan?
Oh, you'd be doing backflips, I think. If you've got a house mortgage or a business loan, both of those go down. I don't know by how much, but from current levels, let's say Dominic's right, we go from a 25 plus to a minus 50. That 75 basis point move, you see, we won't pass all of that on to our retail deposit base. No way. We will only pass on some of it, which means we only pass on some of that to mortgages, but quite clearly they would be 20 to 50 basis points lower than what you're seeing today.
Yeah, so we might get 2/3 of the drop.
Yeah, something like that. I mean, I'm just making it up on the spot. It's our treasury guys that figure that out, but we have found it harder collectively across the banks to pass on rate cuts below 3% in the retail deposit space. We get mortgagees don't seem to scream that much as interest rates are going down, but depositors scream really hard, and trying to balance the two is very difficult, and we found it incredibly difficult going below 3%. I think we're at about 2.5 now on most term deposit rates, maybe even 2 in some parts, I'm not sure, but we would be taking, you've got to cut one to cut the other. How that exactly plays out, I don't think it'll match the decline in the OCR. So the other argument in this, and one which is gaining some traction overseas, unfortunately, is that minus 50 is not enough. In order to really sort of have an impact, you need to go to minus 2%. And in that world, yeah, then wholesale rates are definitely negative. Mum and dad retail rates are definitely getting pretty close to zero, although I still think we would really struggle to pass on a negative rate. And then mortgage rates obviously follow them down as well.
So another question here. someone's saying that Helen Clark is telling us that 75% of the economy is trading again, or 75% of the workers are back. Is that
Yeah,
realistic?
so where she's got that from, she's bang on, or close enough. What I showed on this slide was a table, and it said alert level 1, 2, 3, 4, and GDP reduction. Now these are RBNZ numbers, which are pretty close to Treasury numbers, and the 19% there is what she's referring to. So that under Treasury was as high as 25%. So what she said is we're losing, 25%, but that means that we've got, 75% back and running, which is exactly right. And people think, well, that doesn't sound like a lot, which is why I go into here. You've got the government still running at 90%. You've got, primary sector at 75. You've got utilities at 80. There are still other services at 70%. There's still quite a lot of our economy running, at above 50, 60%. And it's the ones that are getting the most attention are the ones that are running at 10, 20% down the bottom. But now that construction's come back, that to me, that was the big thing, getting construction back, because that's the path we really need to drive going forward.
Thanks, Jared. What about, I've got a question here about the increase in minimum wage that's scheduled. Do you think that's going to go ahead?
I'm not sure. I would have thought that of all times to postpone that, now's the time. For me personally, I think there's a lot of pressure on wages at the moment to go down. My wife works at a media place, and they've all taken a 20% pay cut. To then increase minimum wage would probably put a lot of these people underneath minimum wage, and it would add an unnecessary stress at an unnecessary time. Why can't we just postpone it a year?
Another question here, Jared. How do we pay back all the borrowing?
Well, you could do it two ways. The first way is how I think we will do it. The second way is something a little more cynical. The first way is we print as much cash as we need, and as you're saying, we're going to go from 75 billion to, call it whatever you like, 725, 125, 150, doesn't matter. And then you've increased your debt by quite an extraordinary amount. Still low by international standards. We will not get downgraded. We will not get hurt by international investors for that, which is an important point. So how do we pay it back? Well, what we're trying to do is stop the damage today. This is an important bit. So if we didn't stop the damage today, we would have a weaker economy tomorrow, because we'd lose a bunch of really good firms. And then when we do reopen, well, let's just pretend Queenstown is not there anymore. You've lost a huge revenue generator for the economy. But we want to make sure Queenstown's still there. So we keep them through. We take on debt to make sure Queenstown's still there in 5 years' time. In fact, we might actually boost the infrastructure around Queenstown so that their future output's even more than it is today. And then when you wake up in 5, 10 years' time, if you spend this money wisely and predominantly on infrastructure, you will hopefully have a larger, more efficient economy, which means you have a larger, more efficient tax base to pay back what you've got. Now, there's a lot of holes in that theory, but that is the idea. The other way, which is growing attention, is you just keep printing the cash, and then at some point the government turns to the central bank and says, that IOU, yeah, can we just turn it into something else and then we don't have to pay it back? Yeah, you could do that. How do we do that? Well, I will issue you, the central bank, a zero coupon perpetual bond. What's that? It's a piece of paper that says you give me money and I don't pay you anything back, ever. Oh yeah, okay, I'm the central bank, I'll do that, not a problem. Done. It's happened in Holland, and I'm pretty sure they'll do it in Japan. Okay, so that's direct monetization with no consequence. Well, the consequence comes if you do it all the time and people just don't trust your currency anymore. But there are ways that you can magically make stuff disappear.
So all the fears of capital gains and inheritance taxes you think might be a bit premature?
No, no, I think that was all coming through anyway. I think there will be a need for a good look at our tax system. We had a good look at our tax system and there were some good ideas in there and nothing executed. We have a demographic shift globally where we have a lot more aging population as a percentage of total population. The dependency ratio, continues to rise. So what that means is, that burden, if you like, needs to be carried by fewer people. Japan's the most extreme scenario where what happened to end World War II. You wiped out a generation. There was 60% of the Japanese population under the age of 20. You fast forward 100 years, not even 100 years, and by 2030, over 60% of their population will be over the age of 65. So a huge demographic shift. You need to sort of fund that, and there's a few ways. The first thing which I think we should all be aware of on this call, particularly if you're my age, is that the retirement age of 65 is not for you. That you're not going to get there if you're under the age of 50. The retirement age for me, I'm 43. I expect to be 70. It's already going to 67 in Australia in 2023, and it's earmarked to go to 70 in 2035. So do the maths. If you're my age, you're not getting there. And I think it'll be means tested as well, whether you get a pension. And I think it should be means tested. I think we'll get to a point where, to get the pension, you really should be, low income and unable to look after yourself. And we need to put a lot more savings aside. So all of the above, I think, of where that question is coming, I think all of that stuff needed to be done anyway, just on our demographics alone. And now that we're weakening ourselves, we will have to try and claw back some extra tax down the track. And I don't think many people will necessarily agree with this, but I'll say it anyway. I worked in Australia for a long time. The higher tax bracket there kicks in at 180, 185, something like that, and then you pay damn near 50% on every dollar you earn. Now, I think that is way too high, and there was nothing worse than getting, a bonus in Australia and losing half of it, and then coming home and saying, geez, the tax here for a high income earner is actually quite light. So I think somewhere in between the two. I think our tax brackets are a joke. I think they're really, really bad. I don't think anyone on this call could justify, could say that $70,000 is a high income.
Jared, the currency markets. So, have you got any for the exporters on the call? Any thoughts around where the Kiwi might go?
Yeah. A bit of a confession. I'm actually an interest rate strategist pretending to be an economist. So now I love talking currencies as well, because the currency strategist is a little slower than the interest rate strategist. So basically, if you look at what's happening globally, you see interest rates have all sort of fallen down and in various ways and the like. So what happens in the world right now is Australia, New Zealand, Canada, South Africa to some extent, we're considered commodity currencies, and we perform really well when global growth is doing really well. Global growth has fallen off a cliff. So I've actually been surprised at how high our currency is. I thought it would be in the low 50s, but it's 10 cents higher. I still have that bias to thinking that given how weak the global economy has become, the bias for the Kiwi dollar is lower near term. But then into next year, I think we see that recovery, and I think we see the Kiwi, the Aussie, the Loonie all sort of rallying back into 2021. There's a lot of drivers that go into currencies, but for me, the easiest way to explain it is in good times, Kiwi dollar does really well, in bad times, not so well. And that it's all reflected in our terms of trade and interest rate differentials.
Thanks, Jared. What about the US? So we're watching. There's a question here about, will the weaknesses in the US economy, cause wider contagion, or are they going to bounce out? In your view?
Yeah, it's a good question. So the US isn't as influential as it used to be on trade and the likes, and what they trade is very different to say what China trades and what others do. I think personally they will be quite resilient through this in the end. I think we will see that you have a central bank over there that is doing some really exciting things. That they've gone a lot further than the RBNZ have. They're doing unlimited bond buying, and they're buying bonds directly from Treasury. They're doing some really funky things. And you just have a Republican in charge, and I think the election will come into it for sure. If the Republican wins, then you'll see a bit more confidence and financial markets enjoying that. And I say the Republican because I don't like saying Trump, but it is what it is. Whereas if it's a bit like Labor versus National, although the characters involved are nowhere near as crazy. A national victory here, gets the backs up, gets people's heads up, and with regards to businesses and financial markets are more, likely to enjoy that, and that also does feed through. And that with a Republican coming through over there, they're just more likely to keep throwing, tax cuts and stimulatory measures through this. So I think yeah, the US is weak, like every country is weak right now. Their external sector is quite small, so they are reasonably insular and insulated in parts. But I think like a lot of countries, they'll be bouncing back next year.
Jared, what about the helicopter, dropping cash out of helicopters idea that you were promoting? Do you think that's going to get any traction?
I think it kind of has, and it'll be interesting to see what they do. I did like the extra payment, the winter payment that came in, which was clearly well and above what would be needed. So that was in my opinion, a good sort of cash handout to people who needed it. And I do think they'll take it further and do something along the lines where we wake up one morning with a bit of extra cash in our back pockets. How they deliver that is up for debate. I thought of the Australian example only because I lived there, where they literally threw money into people's accounts. People who earned up to 100,000, no one above that. So I mean, we saw, even though we didn't get the money, we saw the response in Australia, and it was fantastic. A lot of people went out and spent it. And if you do a good advertising campaign around it, saying, right, what are our problems right now? Well, our problems are retail and our problems are tourism. So if I gave you $2,000 each, could you do the right thing and spend it in your local, retail store, or fly down to Queenstown and, have a ski season, down there? And I think a lot of Kiwis would. And you could even give them vouchers or something to say, actually, you have to spend it in retail or tourism. So I think in terms of the propensity to consume that money, when you are given cash for nothing, you're much more likely to spend it. When you are given cash that you've already paid, like a tax rebate or a GST payment, you still consider it to be yours. Oh, they've just given me back what I overpaid them. It's not quite the same. And if you package it in a way where it really is, it's in your pocket now, but I don't want it in there by the end of the month. You know, it's going out there, please. I think that where you get the more stimulus and the multipliers that we use in those scenarios, you know, obviously the more people spend it, the better. But, you know, for every dollar spent, you can generate up to, you know, $5-6 worth of activity. And it, as a one-off fire starter, I think it's a good, I personally think it's a good idea. Whether they do it or not is another question. I think they may water it down and they may just provide it to people under $50,000, for example, or and that's fine. And they will spend a lot of it, but it'll plug a few holes for those people too, which I think is important.
Well, that's great, Jared. Thank you very much. We've got through quite a few questions there. So I just really wanted to thank you for your great presentation. Obviously, this is a fast-moving situation, and hopefully, you know, we might be able to get you back in a couple of months if there's some exciting, if there's some changes to comment on, and get you back in front of everyone. So we've got over 300 people registered on the call, couple of hundred on there at the moment. So, you know, it's been a great success from my perspective. So, hey, thanks very much, and we'll keep in touch. Thanks, everyone.
Thank you for having me on.